Well, yes, you cannot. Okay, Nilesh Shah joins us. Let's take our conversation forward. Is it time to exercise caution, or it's time to understand that we are indeed going through what could be called as, like Rakesh famously says, mother of all the bull market? Nilesh bhai, good morning. Thank you for joining us. There is a very strong case that why markets should correct and why they should have corrected by now. But the bottom line here is that for anybody who's tried to call the correction, let's say 3 months ago, 6 months ago, calling this market top has been a futile exercise. So what should one do? Because this kind of a pattern is unlikely to continue. If you sell right now, you regret because you'll have to buy higher. But if you don't sell right now, then you are also perhaps ignoring the obvious risk.
So Nikunj bhai, there is no way you can predict where markets are going to go. But you can always react to the market situation. This is a fair value market. It has run up sharply, no doubt about it. It is supported by liquidity flows emerging in global as well as domestic market, no doubt about it. But at the same time, it is supported by revival in corporate earnings. Earnings, one can argue whether it's in line with fundamentals 3 months behind, but there is not wide gap between fundamentals and earnings today. So please maintain your asset allocation. We believe this is a market where every correction is an opportunity to buy. And maintain your asset allocation, stay invested in the market for longer term. Markets will go up and down, you don't have a choice. Just ignore the near-term volatilities for your longer-term goal.
Nilesh bhai, the fear factors in the market mainly are three. What will happen to growth, how inflation will haunt us, and the impact of the Delta variant. But for the moment, none of the perceived bearish or the fear factors are translated into reality. Bond yields are under control, inflation is ebbing out, and for the moment it appears that we are in a sweet spot of growth. So what will cause this correction?
Any correction can happen on three accounts when sentiments turn bad. Now, as you correctly mentioned, in the near term, sentiments are linked to COVID-19. As long as we are able to go out to pursue our business activities, vaccination keeps on rising, active cases keeps on falling, the sentiments are likely to remain positive. The second thing is cash flow. Today, we are seeing flows coming in from domestic investors, both retail HNI as well as institutional investors like mutual funds, insurance companies, and pension funds. We have seen buying from foreign portfolio investors. They are all coming here for the growth prospect of India. Now, if our growth falters, undoubtedly some of this cash can reverse. But as of today, the expectation is that growth is likely to accelerate rather than falter. The third and the final thing is the delivery of performance results compared to the expectations. Today, market has certain earnings trajectory in mind. And if that trajectory gets impacted for a variety of reasons, including long-term inflation, then certainly there could be correction. But as of today, inflation doesn't look like a problem. The recent number which got published at 5.3 is fairly lower than market expectations. I think market is able to see through the numbers rather than going by one thought process. And that collective wisdom today is indicating that yes, there will be near-term volatilities, ups and downs in the markets, some corrections here or there, but there is unlikely to be a bigger crash until one of the three fundamental factors gives way. Sentiment turns bad because of third wave, earnings trajectory gets downward, or money flow gets reversed because of the faith on the long-term growth prospects.
Eight out of 10 brokerages, and I would imagine that 9 out of 10 fund managers right now are of the view that there are excesses in the market, whether it is on the valuation front or whether it is based on historical benchmarks. Where do you think there are excesses in the bull market which currently are getting ignored? I mean, if I may request you to be specific about a sector or theme where you think right now markets are pricing in infinity kind of in growth. I mean, projections are being done in Excel sheet rather than being realistic, but rather than realistic numbers.
So Nikunj, more than the sectors, it is the stocks where one can see some excesses. By and large, if you see, domestic institutional investors have avoided companies with lower governance standards. Now, I'm not saying that we have avoided all the companies, but by and large. Second, the excesses are visible today in some of the stocks where floating stock is limited or there is a concentrated buying. Limited floating stock along with concentrated buying can result into higher inflation, higher valuation, and we are consciously avoiding such kind of traps. So there are pockets of overvaluation in market, but that is primarily driven by low floating stock or concentrated buying or both.
Okay, hi Mr. Shah, this is Mubina as well joining in. I was just looking at some of your recent, buys. I see Bajaj Finance making, an appearance, but there's also interestingly an HCL Tech, whereas TCS and TechM, have been sold off by you. So what's, is this essentially the point in the market where you think that, okay, now is when you will see the erstwhile underperformers, though of course you can't say that for Bajaj Finance, but the erstwhile relative underperformers, that will take center stage? Is that, the rotation that you expect will happen from this point on in the markets?
So Mubina, I would like to caution investors that when you look at the data, please try to look through it. We also run a fairly large arbitrage fund. It is India's largest arbitrage fund. Now, in arbitrage fund, when I buy or sell shares, I'm not taking a fundamental view on the company. I'm only interested in arbitrage by buying cash and selling futures. Now, if you include those positions in my cash positions where I'm taking a fundamental buy or sell call, you are going to go to a wrong conclusion. So please try to focus only on non-arbitrage stocks rather than trades which are done for arbitrage. Number two, when you are analyzing my trend, you will have to analyze my trend with respect to my position. Suppose in stock X, I am super overweight and I am booking profit. You will consider it as sell as if I'm a negative on that stock. But I'm not negative on that stock, but I have made so much profit that I have to book profit over there. Similarly, I might be underweight a particular stock significantly and I'm buying something. Now you may consider it as if I'm positive on that stock, but it might be that I just want to, build small positions so that I can monitor that stock and I'm still underweight that vis-a-vis index. So don't look at absolute numbers in a mutual funds trading positions or trading data. Try to analyze that data with respect to the thought process and the position. That will give you better conclusion. Rotation in market is natural. Today's underperformer will become outperformer tomorrow if fundamentals play out. And today's outperformer will have to consolidate and rest a while before they can move further. So as a fund manager on a smaller size fund, we can probably play this kind of rotation. But on a larger size fund, if we try to play rotation, we'll incur more impact cost and liquidity risk on our portfolio. So we try to maintain, let's say, a core portfolio, which is made up of efficient capital allocation, efficient companies. We hold it over a long period of time. Many of our top 10 holdings have remained constant. They go up and down in terms of weight, but in terms of names, they have remained constant for years. And there is a satellite portfolio where we try to rotate based on the valuation and based on the expectations. So this is a fairly complex exercise. Based on a monthly data, you won't be able to analyze, what we are actually doing.
Okay, understood. So yeah, there's the whole arbitrage, strategy as well that plays out when we look at these monthly buys and sells. Mr. Shah, would you be a buyer in auto stocks right now? Because demand is there, and by the looks of it, given the fact that it's the festive season and all indications are that so far it's going to be a good one, consumers have purchasing power, demand is very much there, but unfortunately the auto companies are not able to cater to all of this increased demand because of supply issues. So is this a good time to buy auto companies? Because hopefully the supply issue will not be there forever. It will subside sooner rather than later.
So there are some of the challenges, Mubina, which you mentioned: the chip shortages, the raw material price increase in metal, uh, not in a position to manufacture to create operating leverage, even though there is demand and there is 6 months waiting period. The positive thing for automobile will be announcement of PLI scheme. Auto and auto components today represents about 7% of India's GDP and 1/3 of India's manufacturing GDP. A PLI scheme supporting auto ancillary sectors will be very, very positive. We are underweight in automobile sector, keeping in mind the near-term pressure and also the long-term pressure of moving from fossil fuel cars to hybrid and to electric vehicles. Now, within this, you have ability to accumulate at a price. I'm sure automobile stocks will go up and down when news flow comes out. PLI scheme will lift auto prices, auto sector stock prices, metal price increase or chip shortage news will depress prices. So you'll have to be a patient accumulator of automobile stock, keeping in mind the trajectory of that company's move from petrol diesel cars to hybrid cars and eventually to electric cars. Companies which will be able to transit on this road path should be bought at lower levels.
Right. Nilesh, I remember last time we were chatting, you were talking about as to how the ethanol story is going to do wonders, and this is a re-rating moment for ethanol plays and especially sugar, which is headed in for a super cycle. Would you say that a large part of that trade is already played out, or do you think the meaty trade is well ahead of us, and this is a long haul cycle that we are part of?
The market is super efficient today. We don't have information asymmetry advantage, which we used to have 30 years back. So markets price in things very, very quickly. The story of ethanol is priced into most of the sugar stocks. From here onwards, the stock prices will reflect the profitability growth rather than the re-rating of earnings. Now, within sugar sector, there are some extremely leveraged companies, some extremely well-run companies. My feeling is that now we will see differentiation coming through, where well-run sugar companies creating a good infrastructure for ethanol blending will do well in the days to come. It's their earnings which will drive the stock prices, not the re-rating of that earning. That seems to be behind us.
As limited a space as it may be, Nilesh, but what is your reading on what's happening within the telecom space? Because it almost seems like, are they too big to fail? Is that really is the question that comes to your mind, while we're, of course, awaiting that big decision by the cabinet on the relief package, hopefully today?
So, see, as an analyst, we can try to predict how many consumers you are going to get, what kind of ARPU you can charge, and so on and so forth. We are extremely incapable of predicting government policy decisions. Those aren't possible to be predicted by an analyst. And hence, to invest in a sector where policy and regulations could have material impact will always create its own surprise or the shock. We have been invested in telecom sector, but our focus is more on the players who are able to work on their own rather than who will need policy intervention. Now, in a very simple sense, if a stock goes from 100 to 10, it is 90% drop. And if it goes from 20 to 20, it is 100% jump. Now, we rather try to save 90% drop than to get 100% rise.
Yes. Haven't we heard this again and again? Rule number one, don't lose money in stock market. Rule number two, never forget rule number one. After all, we're dealing, the fiduciary responsibility is that you are responsible to your investors and unit holders. Nilesh, who would have thought that the bull market which currently US economy or US financial markets experiencing will be the longest, the biggest and the fastest after World War I. But it has happened. And for those who've participated, they've made money. Nobody thought 20 years ago that the bond yields which were at 10% in US economy will go to almost zero, but it has happened. And those who essentially were short on bonds, they've made money. What is this big trend now, which you would say that markets will test you, markets will twist and turn, but this is a trend which I'm ready to stick my neck out on ET Now today and say that it will happen. And I'm not giving you the option to use the word SIP.
So Nikunj bhai, on a longer term basis, we will have two kinds of companies, disruptors versus dinosaurs. There will be companies which will not adopt to the evolving scenarios, and they will get massively disrupted by the new age companies. Today, capital is available for ideas. That has taken away one big advantage from established companies. Today, regulations are willing to support disruptions. That has taken away another moat from large listed companies. And clearly, companies which will evolve over a period of time using digital ecosystem or whatever other tools available. And essentially, either they will expand the market at a lower cost, or they will provide better service, better product to investors, consumers. These are the companies which will survive. Now, every company will say that we are digital native, we are doing all these things. But there will be someone who will be doing lip service, and there will be someone who will be doing actual disruption. So you want to be with disruptor, not with the dinosaur in your portfolio. The second thing, Nikunj bhai, which is coming big time is environmental, social, and governance path. We are seeing shareholder activism now coming to India. Earlier, many a times it was below the radar. Now it is out in the open. If you are not walking on the path of governance, then there is a serious de-rating of your stock, your company possible. It may not happen today. It may happen 2 years down the line, but eventually it will happen. So you have to invest in companies which are having good scores on ESG side. This disruptor plus ESG, this will be two big trends which will impact portfolio returns in the future.
Well, both of them are great trends, and thank you very much. Really appreciate your time.